Hey, Courtney Smith here, and I want to talk about one of the most important factors related to the success in trading. And it's something that people, particularly newbies, make the mistake of all the time. This is a super consistent problem. The problem is that people are not persistent and consistent. They waffle, they change the rules, they change whether they use them from trade to trade. And as a result, they get into problems all the time. Let's explore this a little bit closer. Trading is a marathon, it's not a sprint. I don't really like to even look at any data until I have 6 months or a year of data. But what happens is that people that are newbies, they say, "Oh, well, my first three trades are losing trades, therefore this must not work." And of course, that's just basically insane. You see, trading is not a get rich quick scheme. There's no question that we can make massive amounts of money, but it's not something that happens in 3 weeks or 6 weeks or 3 months. It's something that takes place over months and years. And as a result, we need to be consistent and persistent, because if we just look at it as a short-term thing, then we're going to run out of mental gas and we're never going to end up getting the riches that we should get. Sometimes we're lucky, and sometimes we start making money right away, and that's great. And sometimes we're not. And it takes a little while before we actually start to make money. But the key here is to not be thinking of this as something that's going to make you money tomorrow. It's got to be thought of as something that's going to make you money over the coming 6 to 12 months. Short-term track records don't mean anything. I was recently at a conference, and a guy got up and he pitched a trading program. You know, it was a seminar, and he pitched it. It was a $4,000, or no, it was actually, I'm sorry, I take that back. It was a $10,000 fee to buy the product. It was a trading system. And then in order to monitor the techniques, you had to pay him, I think, another $500 or $1,000 a month. So it wasn't really particularly cheap at all, you know. And so when I heard what the price was, I thought, well, wow, this must be an incredible program. And, you know, I'm in the business of selling programs and investing. So I thought, oh, wow, this guy's going to be incredible competition for me. And it's going to be difficult for me to sell my courses after hearing what the expense was of these courses. Well, it turns out that the guy had a system where his track record, he was so excited about it. He talked to me about it after the presentation, and he tried to get me to invest in him. And it turns out that the track record of this amazing system was 6 weeks old. He had a 6 week track record, and it was profitable, but half of the profits came on one trade. So that if you eliminated that one trade, he really had a break even technique over those 6 weeks. So this is what I'm saying. Now, in this case, it was profitable, but I would completely ignore a 6 week track record. If he had showed me a money losing track record, I still would have ignored it. I wouldn't be impressed one way or the other. I need to start seeing 6 months. And furthermore, I really don't even like 6 months track record, because what I want to do is I want to see, well, how well did this method work in bull markets? How well did it work in sideways markets? And how well did it work in bear markets? And I'd really like to see a year of each of those conditions so I can fully understand what my risk and what my reward is by using this track record. But I can tell you right now, I get lots of people who sign up for my courses, and 6 weeks later, they say, oh, this stuff doesn't work. And it's like, what? You got 6 weeks, and oh, by the way, you didn't follow the rules. So it's 6 weeks of not something that I taught. Another thing is, a losing streak is not a reason for changing the rules. In fact, it may be the opposite. Let me explain. I always talk in my courses about how, you know, people will immediately start to freak out if they have 3 losing trades in a row. And I've spoken to other trainers, and they have the same comment, that clients lose confidence in a technique after about 3 losing trades in a row. But it could be any short-term losing streak. Here's the thing. What you need to do is you need to make sure that whatever techniques you use are verifiable and accountable so that you can do back testing. And so what that means then is that you look at the technique and you say, oh, well, it just went through a month. It had 3 losing trades, or it went through a month of losing money, or whatever the losing streak is. It doesn't matter. And then you go back and say, well, what if I had traded this over the last 3 years? Would I have made money? In other words, is the current losing streak an anomaly, or is this what normally happens? The back test will tell you that. Now, let's assume that the methods are profitable and that the short-term situation is the anomaly, the money losing. Well, just because you're losing over the last month does not mean you should change the rules that have made money for you over the last several years. Basically, that short-term period is just an anomaly. It's just, I wouldn't even want to say it's an anomaly. It may be a very normal occurrence in a technique. No technique makes money all the time. So as a result, losing streaks occur in all techniques, and therefore don't change the rules just because you have a losing streak. Because by the time you recognize that it's a losing streak, it's probably over. So changing the rules would be changing the rules at usually the absolute worst time. That's a typical rookie retail investor idea. Oh, it didn't work for the last 10 trades. Let's change the rules. In actual fact, it's a stronger argument that you should actually invest more after a losing streak than change the rules. Now, I'm not about to tell you to do that, but from an economic point of view, you're better off, if you have a consistently profitable technique, you're better off economically to increase the amount of money allocated towards trading that technique when you notice a losing streak rather than when you see a winning streak. And I'll produce some education on that. I call it the Robin Hood theory. We need to be consistent and persistent. We can't be changing the rules all the time, or else the rules have no meaning. And if they have no meaning, then you might as well just trade with your guts. And there's very few people in this world who can trade with using their guts. So when you have a technique, you must be consistent and persistent. You have to trade through the bad periods. You have to trade through the good periods. You just have to pound on the market over and over again, following the rules, because you don't really know necessarily if we're about to go into a hot streak or a cold streak. You don't know if the market's going to go bullish or bearish or strongly bearish, or it's going to go sideways. Now, we can try to predict all those things, but we have to start our trading day with the assumption that we don't have a clue. If we can come up with a clue, so much the better. But our job is not to predict the market. Our job is to make money. And in order to make money, we must consistently and persistently follow the rules. Let me give an example. Let's take a look at this chart. This is a chart of Priceline for the last 4 months of 2011. That's a pretty crappy looking chart if you ask me. I didn't sit down and figure out if we would have made money or lost money, but this was a best of the best stock, and I imagine that we probably lost money in this period of time. It's possible we roughly broke even. I don't think we lost a lot of money, but boy, this is the type of market that tests people's patience. In particular, it's a market that tests newbie traders. They're not getting any satisfaction. They're not making any money. They're selling lows and buying highs, and they're getting chopped up a bit here. I'm assuming that this is a money-losing situation. So, of course, the average retail trader will go through this experience and say, well, this doesn't work. This is a bogus technique, and all I'm doing is losing. This must be a scam. I want my money back. This is terrible. And then, of course, the trader who is the superior trader and who is consistent and persistent and just keeps pounding away then participates in this incredible bull run. Now, this bull run occurred just after that last chart. And if you had done just the first trade, the very first orange arrow there, you would have made about 25% on your money on just that one trade. Just that one trade, 25% on your total portfolio. It was such an incredible bull market. The stop was very tight. So using a 1% risk, you would have ended up with a very large position right at the very beginning of a major bull move. The stock price went from about 490 all the way up to over $760. Now, I couldn't predict that, or I wouldn't want to predict it. After looking at this chart, I will do another video on how we might have been able to predict it. But nonetheless, we have to assume that we never could have predicted it. Most people would have given up trading at the end of this period and would have missed this incredible bull move. Now, the same situation occurred back in 2008. In 2008, the stock market in most countries was down about 45, 50%, and most people stopped trading when they lost that 50%. And of course, they missed the huge bull market of 2009, which would have gotten them almost back to break even. Instead, they retired from trading with a 50% loss. Hey, that's their kids' education. That's their retirement. They were not consistent and persistent. Now, on this chart, when I said that this would have made 25%, that's a true statement. But I've also identified every channel breakout and trend analysis pyramiding. So there was a total of 7 pyramids, which means that you probably would have made 50 to 100% of your money on just this one campaign. Just this one campaign would have been a huge monster profit. And yet, most people would not have caught the trade because they would have been frustrated by the lack of trend over the previous 4 months. So it's important that we're consistent and persistent. Now notice that price line since that incredible bull move, which made us tremendous amounts of money, has basically been drifting lower. Now, fortunately, it's been drifting lower in such a way that it's very unlikely that we lost a lot of money. Probably lost a little bit of money during that period of time, but not too much. You know, maybe 1%, 2%, 3%. But after making 50 to 100% in the first 3 months of 2012, that's a peanut. The point is that as long as Priceline fits the criteria for purchasing, I'll continue to look to be a buyer. I will continue to be persistent and consistent. So let's take a look here. You have to have faith in the system. That the system, whatever system you're using, whether it's mine or somebody else's, you have to have faith in that system, or don't start using the system. The way to have faith in the system is through back testing to see how well it would have worked. Eventually, you'll have real world experience. Persistent and consistent is part of executing flawlessly. If we all of a sudden stop being persistent and consistent, then we're not executing flawlessly. And then why have the system? The system becomes irrelevant at that point because you're not following the system anymore. And as a result, you're just kind of flopping around, and that's going to be psychologically debilitating and probably financially debilitating. So being persistent and consistent is part of a complete program for consistent profits. You cannot be consistently making money if you're not persistent and consistent at following your trading rules.